Hi, and welcome to the Market Axis. Today we will talk about stocks. What are stocks? How do stocks work? And why should we buy them? If you're interested in stocks and the stock market, subscribe to the channel because I will soon upload a video that will explain how the stock market works. Now let's get started. What are stocks? Before I give you a definition of stocks, I would like to take a tiny step back to briefly explain how an incorporated company works. Generally speaking, an incorporated company is created by a group of people who want to start a business together. Every person decides to invest in the business they are creating. When the corporation is created, there is a division of shares of stock, which are then divided between the initial partners. The more a partner invests in the corporation, the bigger the share of stocks he will own. So, stocks are a portion or a stake of a corporation, which can be acquired by people or other corporations. Given this piece of information, why would someone buy a company's stock? Generally speaking, whoever decides to buy a company's stock wants to participate in the business and grow their capital by investing their money in that business. Since they invested their money in the business, they expect to receive some kind of return on their investment. This return generally comes from the distribution of a part of the profit that the company is able to generate. This distribution is called dividend. The dividends are distributed based on the amount of stocks owned by a certain investor. Therefore, the higher my stake is, the more dividends I will receive if the company generates profits. Here's an example. The corporation decides to distribute $400,000 of their profits to its shareholders, people who own the company's stocks. The outstanding shares, so the shares the company has issued, amount to $1 million. To calculate the amount of dollars that will be paid for every share owned, we take the amount of money that will be distributed, so $400,000, and we divide it by the number of outstanding shares, so 1 million, which gives us 0.4. This means that the company will pay out 40 cents per every share of stock. Let's say you own 5,000 shares. To calculate the amount of dividends you will receive, you multiply the number of shares you own, 5,000, by the payout, 40 cents. The result is $2,000. Now, in addition to the right to part of the company's profits, a shareholder usually is entitled to 1 vote per share. These votes can be expressed during annual shareholder meeting. The previously mentioned voting rights are very important because during the shareholders meeting, important decisions are being made, such as the election of the board of directors or the approval of dividends, and so on. By having a large number of voting rights, someone could influence the potential profitability of the company. Here's a very simplified example. SailWest Incorporated has only 4 shareholders who own the totality of shares. So Matt, Martha, Lucy, and Jake own respectively 35, 30, 25, and 10% of the company's shares. During the annual shareholders meeting, Matt suggests the company should invest $500,000 in a new technology which should double their inventory production capabilities. Each shareholder casts their vote. Matt and Jake vote in favor of the investment, reaching 45% of the total votes, whereas Martha and Lucy vote against it for 55% of the votes. So Matt's suggestion doesn't pass. There are multiple types of stocks, and here are the most common types. Common stocks, which are stocks that represent the ownership of the company and entitle you to a dividend and voting rights. Preferred stocks, stocks which entitle the owner to receive dividends before the common stockholders, but do not provide voting rights. Then you have growth stocks, stocks that are expected to outperform the market average; value stocks, which are stocks of corporations that are expected to be profitable even during tough times or recessions. You have income stocks, stocks that provide dividends higher than the market average. And obviously, you have blue chip stocks and penny stocks. Blue chip stocks are stocks of well-established companies that have a large market capitalization. And penny stocks are stocks with an equity valued less than $5. Now, things get interesting. Another upside of owning stocks, in addition to receiving dividends, is that the stock's value can increase or decrease based on the company's profitability. A company's stock can be sold privately or on the public market if the corporation meets certain criteria and standards to be listed on a stock market. Once a company goes public, its shares can be bought and sold by anyone. Usually, the company's stock is traded on a daily basis during the stock market's opening hours, and because of this, the stock's value can increase or decrease based on multiple factors. What attracts most investors is the change in value of a stock, and here is why. Jim buys 500 shares of SailWest Incorporated at $10 per share. Therefore, he invests $5,000. After about 12 months from the initial purchase, SailWest shares have increased in value and are now priced at $12 per share. At this point, Jim decides to sell his shares at the price of $12 for the total amount of $6,000. See, in this case, Jim made $1,000 profit from this transaction. So here's a little recap. What are stocks? Stocks represent a piece of ownership of the company. When you buy a stock, you partially own the company and you participate in the business itself. If the company is profitable and expands, most likely your stock's value will rise. However, if the company does not perform well, your stock's value will decrease. Hey guys, thanks for watching. If you enjoyed the video, please click on the like button and subscribe to the channel so you will be updated on the next videos and, well, you will help this channel grow. If you want to know the 5 initial steps you need to take before investing in the stock market, check out the link in the description below. Alright, see you next time.